Hey everyone, and welcome back to the Deep Dive. Today, we're diving headfirst into the powerhouse that is Amazon.com, Inc., ticker AMZN. We pulled together an incredible stack of research, articles, analyses, really trying to answer one, well, burning question. As Amazon ramps up to pour, what is it, over $100 billion into artificial intelligence, is this the move that cements another decade of unparalleled dominance, or, could it be their most expensive mistake yet?
Yeah.
Especially with all the fierce competition and mounting regulatory pressure we're seeing.
Yeah, exactly. And our goal for this deep dive is really to give you a clear long-term picture of Amazon's value. We're going to systematically dissect its competitive advantages, evaluate the management, dig into the financials, and importantly, shine a light on the risks that could challenge its future. All the data, all the insights we'll share, they're current as of today, June 20, 2025, and Amazon's closing share price, $209.69.
That's right. Think of it like having a seasoned guide walk you through everything you need to know about, well, one of the world's most formidable companies, without you having to sift through countless reports yourself. So let's get started. Okay, so to really get a handle on Amazon, we have to talk about its business model. It's often described as this self-reinforcing flywheel. Fundamentally, yeah, it's a multi-sided platform connecting millions of buyers and sellers. But its true power, I think, as our sources highlight, it comes from its intense vertical integration.
Precisely. Amazon generates revenue through several key streams, right? And each one plays a strategic role in that flywheel, even if their profit margins are wildly different. Think of online stores, their retail side, as Amazon's brilliant bait. It's the largest revenue driver, brings in billions. But here's the surprising twist. It barely makes any money. Its real purpose is just to draw millions of customers into Amazon's orbit. That's where the real money-making magic happens in other less obvious places. So then you have third-party seller services. This is where Amazon earns commissions and fulfillment fees from independent sellers using their platform. Fulfillment by Amazon FBA is absolutely crucial here. It handles everything from storage to shipping for those sellers, and this segment is growing dramatically. Why? Because it offers sellers, well, unparalleled access to customers and a turnkey logistics solution. I mean, think about it. Third-party sellers accounted for a record 62% of all units sold in Q4 2024. That's a significant jump from what was at 56% back in Q4 2021. Now, the undisputed profit engine, Amazon Web Services, AWS. This offers just a vast suite of cloud computing services to businesses globally. It's incredibly high profitability. That's what provides the deep capital to fund Amazon's aggressive investments in every other part of the ecosystem, including that low-margin retail business we mentioned. As of Q1 2025, AWS was operating at an annualized revenue run rate of $117 billion. That's just a staggering amount of cash flow. Okay, next up are subscription services. This is primarily Amazon Prime memberships. With over 200 million members globally back in 2021, these recurring fees generate stable revenue. And they lock in customer loyalty through free fast shipping, Prime Video, a whole host of other benefits. It's really a continuous revenue stream built purely on convenience. And the advertising services segment, this is fascinating. It's Amazon's fastest growing and most profitable emerging stream. They leverage their unparalleled first-party data. I mean, literally what customers are searching for and buying to sell highly targeted ad placements. Imagine knowing exactly what millions of people want to buy right before they buy it. That's powerful. Industry forecasts. They project Amazon's retail media ad revenue alone will surpass $60 billion in 2025. And finally, yeah, there are physical stores, primarily Whole Foods Market, and those experimental Amazon Go convenience stores, which really represent Amazon's continued push into brick-and-mortar retail.
Okay, so this is where it really clicks, right? It's not just a list of separate businesses. It's the incredible synergy between them that makes Amazon's flywheel spin so effectively. AWS generates the massive cash flow. That funds those crucial, but yeah, lower margin, retail and logistics investments. And that sheer scale of the retail business, it attracts a colossal audience. And that audience, in turn, makes the Prime subscription incredibly valuable, which then generates the data that fuels that super high margin advertising business. It's this powerful compounding effect. It creates something far, far greater than just the sum of its parts.
Exactly. And to elaborate a bit more on this ecosystem, within this framework, Amazon has specific products and services that just reinforce each other constantly. The e-commerce platform itself, Amazon.com, with features like one-click ordering and its sophisticated AI-powered recommendation engine, that really defines the global storefront. Then Amazon Prime. It's the absolute cornerstone of their consumer strategy. They even expanded their signature Prime Day event to 4 days for the first time in 2025. That just deeply embeds customer loyalty with its bundle of benefits. And of course, AWS. Still the undisputed leader in cloud computing, offering over 200 services now, including those cutting-edge generative AI tools like Amazon Bedrock and Their custom-designed AI chips like Trainium2. Fulfillment by Amazon, FBA, is just absolutely crucial for millions of third-party sellers. Shipping over 80 billion items globally, it's a critical piece of the whole infrastructure. Beyond that, you've got digital content and devices, things like Kindle, Fire TV, Alexa devices. They serve as these really convenient gateways to Prime Video, Twitch, Audible, keeps you in the ecosystem.
And, in a bold continuation of its day one philosophy, Amazon is aggressively pushing into emerging ventures like healthcare through One Medical, grocery with Amazon Fresh and Whole Foods, and even satellite internet with Project Kuiper.
Wow. So if you put all this together, what does it all really mean? Amazon isn't just a retailer anymore. It's, like some people describe it, the very infrastructure of commerce itself.
Its market position is, well, one of overwhelming dominance. Let's be clear. In U.S. e-commerce, Amazon commands nearly 40% market share. 40%. Globally, its platform attracts an estimated 2.5 billion visitors per month. The total global market facilitated by Amazon, projections put it at $540 billion in 2025, and forecasts suggest it could grow to a staggering $1 trillion by 2033. And of course, AWS is the clear market leader in cloud computing, no question. This immense scale, that's what enables Amazon to make these strategic investments. We're talking tens of billions of dollars annually that most competitors, they simply cannot match. It's like they're playing a completely different game. And Amazon's primary value proposition, the one it famously and consistently articulates, is unparalleled convenience. Simple, right? This is built on three core pillars: low prices, fast delivery, and vast selection. So for you, the consumer, this means a seamless experience. You can find almost any product, usually at a competitive price, with remarkable speed. For third-party sellers, it offers immediate access to a massive global audience and, importantly, turnkey logistics via FBA.
And for enterprise clients, AWS provides scalable, cost-effective, and technologically advanced cloud solutions. It allows them to offload complex IT infrastructure and, innovate faster. Okay, shifting our focus a bit to the broader market. Amazon operates at the intersection of three highly dynamic and, frankly, rapidly growing industries. The global e-commerce market. It's projected to grow at an 8% compound annual growth rate through 2029, driven by trends like hyper-personalization, social commerce, and the significant growth of online grocery sales. So, yeah, still plenty of room to expand there. Cloud computing is experiencing even more explosive growth. It's incredible. The global market is forecast to expand from about $766 billion in 2025 to a staggering $3.5 trillion by 2035. That's a 14.6% CAGR. What's driving this? Well, it's a combination of ongoing corporate cloud migration and the just insatiable demand for computing power, especially the power required by those powerful generative AI models everyone's talking about. And the digital advertising market is also undergoing a huge transformation.
Retail media is becoming a key channel, mainly because of its direct proximity to the point of purchase. AI is, well, indispensable here for targeting and optimization. And Amazon's advertising business, it's forecast to grow at an annual rate of up to 20%. It's perfectly positioned to capture a disproportionate share. Why? Because of its rich first-party shopper data. Like we said, they know what you buy, so they know exactly what ads to show you. But despite this dominance, Amazon faces intense competition. Let's not forget that. In e-commerce, its primary rival is Walmart, right, which is effectively leveraging its physical stores to create a strong omni-channel experience. Other significant competitors include eBay, Shopify, and those rapidly rising fast fashion platforms like Shein and Temu. They're definitely making waves. In cloud computing, okay, AWS is the leader, but it faces fierce competition from Microsoft Azure and Google Cloud, especially in the race for generative AI supremacy. That's where the battle is heating up. And in digital advertising, Amazon competes directly with Google and Meta, the giants.
But its unique advantage, as we mentioned, is that direct link to commerce and that proprietary first-party shopper data. That's their edge.
It really sounds like Amazon has built this fortress around itself. What's fascinating here is how they've made it just incredibly difficult for anyone to truly challenge their dominance at scale. Their competitive moats, they seem fortified by some of the highest barriers to entry in modern business.
You're absolutely right. These barriers are truly formidable. First, the sheer capital investment and economies of scale. It's almost unimaginable. Imagine trying to replicate Amazon's global infrastructure, the fulfillment centers, the robotics, the delivery fleet, those massive data centers. To even begin to match that, you'd need to invest not just billions, but potentially hundreds of billions every single year. It's like trying to build a new ocean, not just a new ship, right? And that scale provides immense cost advantages. Second, their brand and trust. Amazon's brand, built painstakingly over 2 decades, is globally recognized. It's practically synonymous with convenience and reliability for millions. Building comparable brand equity from scratch, that would be a monumental task for any newcomer. Third, their technology and data.
their proprietary algorithms for logistics, pricing, personalization, along with that vast trove of consumer data. These are unique and incredibly difficult to imitate assets, and they power that lucrative advertising business. And finally, network effects. The Amazon marketplace is just a classic example of a two-sided network effect.
More buyers attract more sellers, which increases selection and value for buyers, which attracts more buyers. It's a self-perpetuating cycle. This is coupled with significant switching costs for both customers. I mean, think about all your saved info, Prime benefits, Alexa integration, and for sellers too, who have inventory tied up in FBA and established product listings with reviews. It makes it incredibly difficult to leave the ecosystem once you're in. And AWS also benefits from really high switching costs for enterprises once they've integrated their systems onto the platform. Now, what's significant and growing threat to this behemoth? The regulatory environment. No doubt about it. Antitrust is probably the most pressing challenge right now. There are ongoing investigations and lawsuits in the US and Europe examining its market power, its dual role as both marketplace and seller, and a potential disadvantaging of third-party sellers using its platform. The risks here are substantial. Massive fines, forced operational changes, or even potentially a forced breakup of parts of the company. That's the big fear. Beyond antitrust, you have data privacy laws like GDPR in Europe.
These mean increasing compliance costs and penalty risks. Labor practices are under constant pressure regarding warehouse conditions, safety, productivity targets, and the company's, aggressive stance against unionization. That gets a lot of headlines. And historically, Amazon's taxation strategies have drawn significant criticism, posing a risk of future tax law changes that could impact their bottom line.
Yeah, it sounds like these ethical challenges are maybe more than just PR headaches for Amazon. Could you walk us through a concrete example? Like, how could their labor practices or their tax strategies actually hit their bottom line or, fundamentally change their business?
Well, they absolutely can. For instance, the ongoing scrutiny of labor practices. That can lead directly to higher legal costs from lawsuits. It can lead to increased employee turnover, which is expensive in itself. Hiring and training costs add up. And it could even lead to successful unionization efforts, which would fundamentally change operating costs and flexibility. Criticism around tax practices. Well, that could easily lead to changes in tax law in major markets, directly impacting profitability. It's a real risk. And, negative public perception from all these issues can translate into consumer boycotts, even if they're small. Over time, that erodes that critical brand trust we talked about. So, yeah, these aren't just abstract concerns. They have very tangible potential financial consequences. Okay, let's talk about Amazon's management, led by CEO Andy Jassy since July 2021. His tenure so far has largely been defined by his response to those post-pandemic challenges. It was a tough handoff. He tackled the significant overcapacity from the pandemic boom by initiating the company's first major layoffs. That affected over 27,000 corporate roles through 2023, and he also cut some unprofitable ventures. Tough decisions. He also implemented that controversial but steadfastly defended return to office mandate, arguing it's essential for preserving Amazon's culture of invention. That caused quite a stir. So he's certainly not shied away from making difficult, sometimes unpopular calls. More recently, Jassy has been pretty proactive in addressing the disruption of AI. You have to give him credit for that. In a June 2025 memo, he communicated that AI would inevitably lead to a reduction in the corporate workforce, but he framed it as a reinvention of work rather than just, job cuts, trying to manage the narrative. Overall, Jassy is generally described as a pragmatic, very data-driven operator, focused on operational efficiency and profitability. He even introduced a no bureaucracy initiative internally. So given Amazon's enormous cash flow, the next logical question is, where are they putting all that money?
Right.
Because how they invest it now is really going to dictate their dominance a decade from now. It's critical.
Yeah.
Capital allocation strategy. It firmly prioritizes long-term growth and market leadership. That's clear. The most dramatic example is its massive capital expenditure plan, CapEx, projected to exceed $100 billion for 2025. This colossal investment is overwhelmingly directed toward building out AWS infrastructure and generative AI capabilities, including, for instance, a newly announced $20 billion investment in Pennsylvania data centers. This signals a very clear strategic decision: dominate the foundational platforms for future growth. Amazon's M&A strategy is also really an extension of this. It's not random. They acquire strategic assets to accelerate entry into new, large-scale industries. Think Whole Foods for groceries, MGM for Prime Video content, and One Medical for healthcare. This isn't about financial engineering. It's about integrating these assets into the Amazon flywheel to disrupt new industries. Now, regarding share buybacks and dividends, for most of its history, Amazon explicitly did not return capital to shareholders. They reinvested everything. This started to shift slightly in 2022 with a new $10 billion share repurchase authorization. However, execution has been, let's say, opportunistic. Only $3.9 billion was used by mid-2024.
And shares outstanding have actually continued to increase due to stock-based compensation for employees. Amazon has also famously never paid a cash dividend, and they consistently state they intend to retain all earnings to finance growth. This no-dividend policy is actually a critical enabler for funding those ambitious AI investments internally. It allows them to reinvest absolutely everything.
Okay, so when we look at how Amazon is investing all this money, what really stands out to you about their efficiency? I mean, how effectively are they actually using shareholder capital?
Yeah, that's a great question. What really stands out is a strong recovery in its return on invested capital, or ROIC. As of the trailing 12 months ending in Q1 2025, Amazon's ROIC stands at a pretty healthy 13.7%. Think of ROIC as basically how efficiently a company is using your money, the investor's money, to generate profits. And a 13% return is really quite strong, especially for a company this enormous size. It shows they're generally making smart bets. Now, the figure did see a sharp dip, down to just 1.83% back in 2022. That was due to intense post-pandemic investments in logistics, but the robust recovery to over 13% by 2024 and into 2025 clearly demonstrates the positive impact of Andy Jassy's cost-cutting measures and the accelerating profitability of those high-margin segments like AWS and advertising. This performance has even earned Amazon an exemplary capital allocation rating from Morningstar, which is quite an endorsement. All right, let's dive into the actual numbers that define this company. As of June 20, 2025, Amazon commands a market capitalization of approximately $2.23 trillion. That places it firmly among the world's most valuable companies. Revenue growth.
Well, while it's moderating from its hyper-growth phase of the past, it remains robust for a company of this scale. The 5-year compound annual growth rate, the CGR, from FY 2019 to FY 2024 was a strong 17.9%. For the trailing 12 months ending Q1 2025, revenue reached $650.3 billion. That's up 10.1% year over year, still growing nicely.
So while maybe the breakneck speed might be shifting a bit, does this mean Amazon is maturing into a different kind of company? One where profitability becomes even more critical than just sheer top-line growth.
Absolutely. I think that's exactly right. And one of the most significant developments in Amazon's financial story over the past few years has been that steady, impressive expansion of its profit margins, which is exactly what you'd expect as a company matures and focuses more on the bottom line. So for the trailing 12 months as of Q1 2025, Amazon's gross margin was 49.16%. That's a significant improvement from, say, 39.6% back in 2020. The operating margin also saw a substantial expansion, reaching 11.02% for TTM Q1 2025. That's up significantly from a 5-year average of just 6.15%. And this is a direct result, really, of the increasing dominance of those high-margin segments like AWS and advertising. I mean, to put it in perspective, AWS's operating margin was a formidable 39.5% in Q1 2025, 39.5%, while North America retail was, 6.3%, and international retail was just 3.0%. The net profit margin for TTM Q1 2025 was 10.14%, dramatically up from its 5-year average of 5.34%. This really tells you, plain as day, where the real money is being made now.
Okay, so this consistent margin expansion is clearly a key pillar for the bull case, right? Makes sense. But is there a flip side? Are there any hidden costs to this push for profitability, or does it maybe make them vulnerable in new ways?
Well, the trade-off, especially in the near term, often shows up in free cash flow. That's FCF. Now, you might look at the numbers and see Amazon's free cash flow, essentially the cash they have left over after all their daily operations and investments dropped sharply. It went down to $25.9 billion for the trailing 12 months ending Q1 2025. That's a 48% decrease from the prior period. Looks bad, right? But, and this is crucial, don't let that fool you. This isn't a sign of operational trouble. In fact, operating cash flow actually grew 15%. The decline in FCF was a direct result of a very deliberate management decision. They decided to dramatically increase capital expenditures, CapEx, by nearly 80% to $88 billion. And where did that money go? Mostly for AWS and AI infrastructure. It's like a homeowner taking a huge chunk of their savings to build a massive income-generating addition to their house, right? The cash on hand goes down now, but it's a strategic investment for potentially much bigger returns later. We saw similar negative FCF back in 2021 and 2022 during that huge pandemic-era logistics network expansion. It's investment spending.
Right. So an investment in Amazon today is in many ways really a bet on management's ability to successfully execute these massive long-term capital projects.
Exactly. That's a great way to put it. In terms of overall financial stability, Amazon's earnings consistency has significantly improved. Outside of a weird 2022 anomaly, which was due to a non-cash loss on their Rivian investment, they've consistently beaten analyst EPS expectations for 8 consecutive quarters now. Pretty good track record. Their debt-to-equity ratio is very strong, very conservative at 0.215 in Q1 2025. That actually shows a net cash position, with $94.6 billion in cash versus $65.8 billion in debt. They have more cash than debt. And this ratio has steadily decreased over 5 years, signaling good financial discipline. The current ratio is stable and healthy at 1.05 in Q1 2025, indicating good short-term financial health. And as we mentioned, they've never paid a cash dividend. They just reinvest everything back into the business. Okay, let's talk valuation. How much is this thing actually worth, or what does the market think it's worth?
From a relative perspective, as of June 2025, Amazon's trailing 12 months price-to-earnings ratio, the PE ratio, is approximately 34 to 35. Historically, this represents a significant contraction from its 5-year average of about 76 and its 10-year average, which was way up at 134. This PE compression happened because earnings grew much faster than the share price over those periods, which some see as a bullish signal, suggesting it's kind of growing into its valuation. It's like a highly anticipated movie that finally delivers on all the hype and the reviews catch up to the initial excitement.
Interesting. So the market isn't giving Amazon that like sky-high growth premium it once commanded. What does that tell us about investor expectations now? Maybe compared to, say, Walmart or Microsoft or even Google.
Yeah, it suggests the market is pricing in a more mature but still, significant level of future growth compared to some of those peers. Its PE is currently lower than Walmart's and Microsoft's, but it's still higher than Google's, Alphabet's. So this tells you investors still see substantial growth ahead for Amazon, maybe more than Google in some ways, but perhaps with a clearer, maybe less speculative path to profitability than in previous years. The story is shifting.
Okay, so beyond just these relative comparisons, how do serious investors actually try to estimate a company's standalone, like, true worth, the intrinsic value?
Right, that's where discounted cash flow analysis, or DCF, comes in. It's a fundamental valuation method. Think of it this way. The intrinsic value of any company is essentially what all its future cash flows, discounted back to today's dollars, are worth. So DCF tries to get to that number. How? By forecasting how much free cash flow a company will generate over many years, then estimating a final terminal value for everything beyond that forecast period, and then using a discount rate which reflects the time value of money and risk to figure out what all that future cash is worth in today's dollars. It's a really powerful model, but it's super important to remember it's highly sensitive to the assumptions you make about growth rates, margins, and that discount rate. Garbage in, garbage out, basically. So based on various educational DCF models that analysts run, Amazon's estimated intrinsic value range is actually quite wide. It typically falls somewhere between 176 ticks and $286 per share. Now, this wide range isn't necessarily a flaw in the model. It really reflects the high degree of uncertainty surrounding the potential return on Amazon's massive AI investments. It's a big variable.
Key assumptions for a DCF for Amazon would include, say, free cash flow growth rate of maybe 10% to 17% for the initial high growth period, and then a perpetual growth rate maybe 3% to 5% after that, sort of tracking the broader economy. The discount rate, or weighted average cost of capital, WACC, for a company like Amazon is typically assumed to be between 8% and 10%. And importantly, the initial FCF figure might need some normalization, given that current heavy capital expenditure cycle we just discussed. You have to adjust for that investment phase. Okay, turning to market sentiment. What is the market actually saying right now? Well, the perception among Wall Street analysts covering Amazon is, frankly, overwhelmingly positive. The consensus rating is buy, or moderate buy, with a significant 57% of analysts rating it a strong buy. Consensus price targets generally cluster around the $245 to $250 mark, with the more bullish targets reaching up to $280. Morningstar, for instance, assigns a fair value estimate of $240. So this implies a potential upside of roughly 15% to 30% from the current $209.69 share price. Analysts are pretty optimistic. The general media tone is also predominantly positive.
Lots of focus on Amazon's AI potential, the continued strength of AWS, improving retail profitability, that booming advertising growth, and, CEO Jassy's cost-cutting efforts getting results. However, this optimism is definitely tempered by some concerns. News of those AI-driven workforce reductions, potential U.S. tariffs on Chinese goods impacting sellers, and somewhat tempered forward guidance from the company itself, citing factors like unfavorable foreign exchange rates and that drag on free cash flow from the massive capital expenditures.
So it does seem like there's a bit of a disconnect, maybe, between this overwhelmingly bullish analyst community and maybe the stock's more recent, somewhat sideways performance. Is the stock kind of in a show-me phase right now? Like, prove the AI spending is worth it?
It certainly appears that way. Yeah, show-me phase feels right. Looking at key market indicators, short interesters, the percentage of shares bet against the company is exceptionally low at just 0.64% of float. That indicates a very highly bullish market sentiment overall. Very few investors are actively betting against Amazon right now.
Right. But, looking at it from a contrarian viewpoint, couldn't such a lopsided consensus also represent a kind of hidden risk? Like, If everyone's already bullish, who's left to buy if there's negative news? Could it fall harder?
That's a very valid point. Extreme consensus can sometimes be a contrarian indicator, yeah. Technically speaking, though, the stock is currently trading comfortably above its 50-day simple moving average, which is around 197 average. That's generally seen as a bullish signal for short to medium-term momentum. It's also trading above its 200-day moving average, around 200-203 does, which is a key indicator analysts watch for a healthy long-term uptrend. And the fact that the shorter-term 50-day average is above the longer-term 200-day average, that forms a golden cross pattern, which further confirms this technically bullish sentiment, at least for now. Now, when we look at Amazon's ownership structure, who actually owns the company? It's dominated by institutional investors, think big mutual funds, pension funds, ETFs. They hold somewhere between 52.8% and 64.6% of all the shares. The top 5 holders include household names: Vanguard, BlackRock, and State Street. This reflects a huge prevalence of passive index funds owning Amazon. This creates a kind of inertial stability for the stock, right? These funds aren't actively trading based on daily news.
But it also maybe means less active pressure from shareholders for strategic changes, like initiating a dividend, for example. Insider holdings are also significant, ranging from about 9.65% to 10.13%. But this is largely concentrated in founder Jeffrey Bezos, who still holds a massive 8.56% stake. He's still the biggest individual owner by far. Other executives, like CEO Andy Jassy, also hold substantial positions, aligning their interests with shareholders.
Okay, and it's probably crucial to contextualize this. Recent insider transactions that get reported, they are overwhelmingly sales, right? Something like 54 to 102 reported sales over 6 months and basically 0 open market buys.
That's absolutely right, and it's important to understand what that means and what it doesn't mean. These sales are generally normal. Insiders sell stock for compensation, for diversification, they have a lot tied up in one company, for taxes. And often, these sales are part of pre-scheduled plans, called 10b5-1 plans, set up months in advance. So the consistent selling isn't necessarily a direct bearish signal on its own. We see it at lots of tech companies. However, the complete absence of open market buying by insiders, that can be more telling, because open market buys signal a strong belief from management that the stock is currently undervalued. We're not seeing that. Overall, ownership is highly concentrated. The top 25 shareholders own nearly 47% of the company. And Jeff Bezos, plus the top 3 institutional holders, Vanguard, BlackRock, State Street, together control over 17%. This concentration ensures that the founder's long-term, often innovation-focused culture remains deeply embedded in the company's DNA.
Okay, so let's try to sum things up a bit. Let's maybe look at Amazon's strengths and weaknesses and then the external opportunities and threats it faces, like a SWOT analysis.
Sure, sounds good. In terms of strengths, well, where do you start? Dominant market leadership and a globally recognized, trusted brand. That's huge. It has highly diversified, high-margin revenue streams now, particularly AWS and advertising. These provide resilience and significant profit generation, unlike the old days. Its unmatched logistics and distribution network is a massive core competitive advantage, just incredibly hard to replicate. Plus, its technological prowess and clear leadership in AI. Can't ignore that. And all of this is supported by a fortress balance sheet, giving it tremendous financial firepower for investments or weathering storms. However, there are notable weaknesses. Let's be balanced. There's a definite dependence on third-party sellers, which can bring issues with quality control, counterfeits, things Amazon has to constantly combat. Its core retail business, as we discussed, still operates on notoriously thin margins. Always a pressure point. The company faces persistent negative ethical and reputational issues. Think labor practices, tax avoidance, which, as we discussed, can translate into tangible business risks, not just bad press.
The sheer complexity of its massive global business model also creates inherent execution risks. It's a lot to manage. And relatively speaking, its international success hasn't quite mirrored its U.S. dominance in all markets, posing an ongoing challenge. Now for opportunities. There are massive ones. AI integration and innovation stand out. This could be truly transformative for AWS growth and potentially create whole new services and markets. There's huge potential in expanding further into new markets and verticals like emerging e-commerce globally, healthcare, grocery, dockery, maybe even satellite internet via Kuiper. The underlying secular growth in cloud computing and digital advertising provides incredibly strong long-term tailwinds. They're in the right industries. And there's continued opportunity to expand those subscription services, growing the Prime member base and that valuable recurring revenue stream globally. Lastly, the threats. And they are significant. There's intense global competition from very well-capitalized rivals, Walmart, Microsoft, Google, Meta, across all its major segments. They're not standing still.
Global regulatory scrutiny, particularly those antitrust actions, is arguably the single greatest threat.
The risks include massive fines or, even in a worst-case scenario, a forced breakup of the company. That looms large. Geopolitical and macroeconomic risks, like economic downturns affecting consumer spending or trade wars disrupting supply chains, are also major threats. And of course, cybersecurity threats are a constant concern for a company holding so much sensitive customer and corporate data. Diving a bit deeper into those macroeconomic factors. Inflation, for example. It directly increases Amazon's operating costs, think fuel for delivery, wages for warehouse workers. And it can also erode consumer disposable income, potentially reducing discretionary spending on retail goods, especially non-essentials. While Amazon has some measures, like fuel surcharges, there's ultimately a limit to how much cost they can pass on without hurting demand. Interest rates also pose a significant threat, particularly to its valuation. As a long-duration growth asset, meaning much of its value is based on future earnings, rising interest rates increase the discount rate used in valuation models. That lowers the present value of those future earnings. Higher rates also increase borrowing costs for its massive CapEx programs. And then there are specific geopolitical factors, like those U.S.-imposed tariffs of 2025 we've seen discussed. These tariffs, some potentially as high as 145% on electronics, directly increase costs for sellers on Amazon's platform. Remember, over 50% of the top third-party sellers are reportedly Chinese. This forces sellers to either absorb the costs, hurting their margins, or raise prices, which can lead to demand erosion from consumers. It's also pushing sellers into a complex and costly China plus one supply chain reconfiguration, moving some production to places like Vietnam, India, Mexico. That's not easy or cheap. Interestingly, though, there's a potential asymmetric impact here. While tariffs clearly harmed the low-margin retail marketplace side of Amazon, the resulting supply chain chaos could actually create an opportunity for the high-margin AWS division. As companies scramble, they might demand more cloud-based logistics, supply chain management, and data analytics tools to navigate the complexity. So a potential silver lining for AWS.
Okay, so to synthesize everything we've covered, let's try to lay out the key bullish points to the bull case for investing in Amazon today. First, its clear transformation into a highly profitable enterprise. This is driven by those high-margin AWS and advertising segments, which now contribute the vast majority of operating income. It's not just a retailer anymore. Second, that colossal $100 billion-plus investment in AI. Bulls see this as the next great growth engine for AWS and potentially entirely new services, promising significant future returns. Third, Amazon possesses a wide and arguably very durable competitive moat. Built on its brand, its scale, network effects, proprietary technology, it's incredibly hard to disrupt at its core. Fourth, under CEO Andy Jassy, there appears to be a renewed focus on capital discipline and operational efficiency, which is already showing up positively in improved margins and ROIC. And fifth, from a valuation perspective, it appears more attractive than it has been in years, mainly due to that significant PE contraction we discussed. It seems to be growing into its valuation. However, the bear case presents significant and very tangible risks that absolutely cannot be ignored. First, the simple law of large numbers. It becomes mathematically much harder for a company of Amazon's gargantuan size to sustain its past hypergrowth rates. Its core e-commerce business is inevitably maturing. Second, that massive capital expenditure on AI represents significant risk. There's absolutely no guarantee of success or the expected ROI, and it could create a drag on near-term free cash flow and potentially disappoint investors if results don't materialize quickly. Third, there's fierce, well-capitalized competition, particularly threatening AWS margins as rivals like Microsoft and Google push hard and compete on price. Fourth, the global regulatory overhang, especially potential antitrust actions leading to fines or even a forced breakup, remains perhaps the most significant and existential threat to its current business model. And finally, the business remains highly vulnerable to geopolitical shocks and macroeconomic risks, things like a global recession hitting consumer spending or an escalation of the U.S.-China tariff war further disrupting supply chains. So once we put all that together, remember that estimated intrinsic value range from our educational DCF models? It's quite wide, reflecting this uncertainty, somewhere between 176 teachers and 286 teachers per share.
Okay, so wrapping this all up, what does all this mean for you, the listener, and for Amazon stock right now, trading around $210?
Well, the current share price of $209.69 as of June 20, 2025 falls squarely within that estimated intrinsic value range we just mentioned. Right in the middle, basically. What that suggests is the market is currently balancing the powerful bull case, the undeniable strength of AWS, the rapid growth of advertising, the immense future potential of AI. It's balancing that with the very real bear case risks, which include the drag from those massive capital expenditures, the persistent threat of disruptive government regulation, and those broader macroeconomic or geopolitical headwinds. So at its current level, the stock price seems to reflect a perhaps rational assessment of a company at a truly strategic crossroads. A company with a potential path to tremendous future value creation, yes, but a path that is clearly paved with significant and undeniable risks. It's not a sure bet either way.
A truly fascinating crossroads for Amazon indeed. And as you, the listener, reflect on this deep dive, maybe consider this provocative thought. What aspects of Amazon's incredibly powerful flywheel do you think are actually most vulnerable to disruption in the coming years? And which parts seem most resilient for the future? Something to chew on. Thank you so much for joining us on this deep dive into Amazon. We really hope you're feeling a lot more informed and maybe ready to think critically about this incredible, complex company. Until next time.